when you play backgammon, do you start this way or the other way? Or does it matter for you? Do you have a specific way that you look at the game?
Yeah, I like to go this way.
This way.
So
White, black, does it matter for you?
Top right down to bottom right.
How does it matter? Or is it just because I know when I play chess, if I start, in a certain angle on the board and then I need to shift my head to the side, it's completely throws me off.
I agree. Yeah, for me, it doesn't matter odds wise or obviously whoever rolls first has advantage, but it's just pure optics. And same thing with chess. I agree with you. If you shift your head to the side, then it's very disorienting. Or even I'll play chess a lot online, and then even coming to a live board, and then just having to reorient myself to the pieces is I understand what you're saying.
But okay, so for the people who weren't with us before we started the recording, Backgammon, how did you reach that? Because I understand the poker, and you are not the first poker player or previous poker player that been on the show, and of course golf, right? And we'll use that as a tip to the end, maybe. How did you end up rolling the dice?
Yeah, so backgammon, it was really, much like poker, it's social groups, right? Or even golf, right? You're going to join a golf club, so you want to be good at that game. Poker was something me and my friends did. We got into it right when they started doing the whole cams on, TV, when you could play online. And then, Rounders, the movie came out, and it just, all of us were like, this is, it's kind of those three things hitting. And, it was what we did as a group or a community. So same thing with backgammon. I had never learned, but then, I've got neighbors in my, friends and neighbors in my community, and they're like, yeah, we play backgammon. I was like, all right, well then, no time like the present, we're going to get to learning that game. And that's what I've been studying for the past, couple months.
So cool. So Jarid, first of all, thank you very much for joining the podcast. It's a great having you on board. So shall we start from the background? Can you tell us, the audience, about you? What do you do? And how did you get into insurance?
Yeah, you bet. And thanks for having me. I've been looking forward to this for a while. So awesome that we're finally together.
Finally, took us only 2 months. Only 2 months.
It took a little while, but we got it worked out. So, so my background, it's always been financial services. So when I finished university, I was interested in being a stockbroker, an investment advisor. So I started my career in that space, and financial planning, retirement, things of that nature. And what I quickly realized was, as much as I liked the conceptual, analytical aspects of stocks, investments, etc., what I wasn't prepared for was the emotional aspect of it, of investing people's money. The market goes down, they're calling you, they're upset, or and could probably handle it better now, but at the time very young, so the psychological aspect of it was I found challenging. Quickly realized I prefer more business to business type transactions, and then so moved my focus into financial planning for businesses and business owners, which is more on the tax side and more on the insurance, risk management, asset protection side of things. And so in 2004, me and my partner founded a company called Risk Management Advisors. And what Risk Management Advisors does, we design, implement, and manage captive insurance companies. And I think but for those in the audience who don't, a captive is an insurance company that a business sets up to insure its own risks. So you go to the Department of Insurance, you get a license for your insurance company to actually issue insurance policies. And to draw the parallels, people will say, oh, you mean like self-insurance? And yes, like self-insurance, but it's much more formal. Again, you're getting that license, you're setting up a separate entity. And the reason you would do this is why go to the hassle is insurance companies get very favorable tax treatment under the Internal Revenue Code. So if I'm self-insuring, let's say I save money, whatever I don't send to the insurance company, I save that money, but then it immediately flows into income and I have to pay taxes on that. But now I don't know if I've had losses yet, right? So I might have a loss, but now I've, sent part of that money to the government. Now I have less money to handle my self-insurance with. Whereas with the insurance company, you pay the premium over, you expense it like you would a normal, insurance premium. But then now it's in your insurance company and you can put it into reserves to pay potential claims. And, you don't have to pay, you don't have to pay taxes until all the underwriting profit is settled. So it's a more financially efficient way to, run your insurance program or self-insurance program.
Do you
Go
also
ahead.
enjoy the float from the reserves?
Correct. Yeah, exactly. So, Warren Buffett, if you read his annual reports for Berkshire Hathaway, one of the big advantages he talks about is not just their investing prowess, but the ability to take reserve dollars and apply that investment prowess to, basically you're sitting on other people's reserves and losses, but you're earning interest income along the way. And so that's called the float, and that's a big benefit.
Let's start from your current customers, for example. When does it make sense for a company to create its own captive?
Yeah, good question. So captives used to be something that was mainly for publicly traded companies, Fortune 500 companies, you know, organizations with huge scale. But then, like so many things, it's condensed down. There's only so many of those companies to go after. Now the biggest growth where we're seeing is in the middle markets, privately held, closely held companies. I mean, anywhere from on the low end, 10 million in revenue up to hundreds of millions of dollars of revenue, or even $1 billion in revenue. But again, more closely held, privately held companies. You still need that. You still need that scale, right? Captives. It's not the least. It's not the most inexpensive strategy. So there is a fee structure, and you need to be able to cover that, hurdle rate, if you will, to make it worthwhile. But really, you're focusing on any industry that has disproportionate risk. Manufacturing, real estate, developers, staffing, contractors, large restaurant groups, mortgage companies, banking, finance. So really, any industry you can apply it. They just need to have the scale to, have it make sense.
So if we are talking about a startup, an InsurTech startup that wants to have some sort of capacity, can they leverage this solution so they can go to market faster?
Potentially. So where we're seeing startups utilize captives is in really on the warranty side of things. So if they have a product that they're looking to take to market, maybe that product's unproven. So we're seeing this in like gene therapy, on the healthcare side, where so you have these drug manufacturers, and they've got these high cost drugs that they want to get to market to treat these rare, difficult conditions. And, the doctors say, hey, that's great. How do I know if, it's going to work? Okay. They give them the medical data, but then, then you're asking the payer, be it the health plan, the health insurance company, self-insured companies, to actually pay this. It could be $300,000 to $3 million per treatment. And it's like, well, what if it doesn't work?
Yeah, I'm just thinking about, most definitely a life science startup or company with, and needless to say that everything in bio, pharma, or medical, it takes years to build that company and tens, if not hundreds of millions, and most definitely there is an opportunity. But I was more curious about InsurTech startups that want to start an MGA or to start to play with that. Is that a solution that they can utilize to have a capacity besides running and funding a fronting company or running after some sort of a reinsurer that through their network will give them from a different MGA or a different paper?
So you're asking for like actually insurance producers and their ability to utilize. Yeah, we're seeing a lot of that really on both sides of the aisle, both in the benefits the health insurance side of the equation, we've got a lot of TPAs and brokerages that are getting really proactive in helping clients keep their claims down, keep their losses low. And then so in turn, they're willing to put, skin in the game, if you will, chips on the table and take some of that, underwriting risk, for their, clients and customers that are implementing their programs. So, and there are reinsurers out there. We just did a deal with a large, TPA, third-party administrator in Arizona. And, they're going to take on a certain amount of risk within their captive for their clients. And we've got reinsurance, up and above, I think it's $1 million, per occurrence, to protect them from anything truly catastrophic. So yes, that's definitely doable. Also, flip side, we're seeing a lot of that on the, automobile insurance, auto liability for companies is pretty difficult right now. But for, agencies who have clients and customers that are doing it better than everybody else, really adhere to, good safety mentality. You can definitely set up, structures where the agency or the MGA, MGU can participate in the risk. Certainly.
So how is it's the first time that I hear that TPA is creating that type of a solution, because I've seen brokers that will have they will take the loss and the claim to their own book. So, or they will pay it so their book will be nice and complete, and they will keep favor with the carriers because that's their arrangement. So they will keep it there, which I'm not really sure how legal it is or not. But the TPAs, that's an interesting solution. What motivated them to jump into the risk game? Because their job is to be later on when there is a claim, unless it's a different type of a TPA. Are we talking about property and casualty or health TPAs?
This is mainly on the health side.
Okay, now it's starting to make sense to me. Okay,
cool.
Yeah.
So on the casualty side, that would typically be much more, brokers, or MGAs, people that are, working directly with the client, touching the risk. Theoretically, you could do it as a TPA, but I mean, frankly, there just aren't that. I mean, there's only a handful of TPAs, that really service, the larger clients, and I'm not sure what they're doing with respect to captives. Maybe they have it, maybe they don't. But yeah, the TPA phenomenon, that's on the health insurance side. Because their whole thing is, we're charging these fees,
mm-hmm.
but we're the ones doing all the work, controlling all the risk. We should actually, get some of that underwriting profit. That's the mentality there. And then on the casualty side, similar to what you were saying.
No, okay. So explain me, because I'm less familiar with the health insurance. I know PNC. I think that I understand life pretty well, but I'm sure every day I learn something new. How the TPA operates in health insurance, because I know, sadly, that when I go to the doctor, the insurance company dictates the time and the type of service that they can offer me. What's the role of the TPA?
Yeah, so the particular TPAs that we're working with, when you're in the health insurance setting, where you go, what you were getting at, really dictates a lot of how much it's going to cost. Because it's crazy. So let's say I need a shoulder surgery, torn labrum, whatever. I could go, to UCLA Medical Center, very good. Across the street, Cedars-Sinai, and they may charge 4 times as much for the same procedure. It's same shoulder, different place, a few blocks away. The price varies wildly, just depending on where you go. And then people always assume, well, if you're paying more, they must be better. But the data actually doesn't bear that out. A lot of times it's the place that can do it for less because they've done it more and more. Their systems and processes are better around that, particular procedure. Or maybe it's just a zip code thing, right? The real estate's more expensive in this part of LA. And then, so they need to charge more. It doesn't necessarily mean quality. So what these TPAs, these third-party administrators are doing is they're giving the information, they're steering, the employee, the member, in the right direction to a place where they know the job will get done right, and they won't get billed this crazy, this crazy amount. They can pay a set, predictable, fair figure. And, you do that for the few large claimants. It's like anything. 90% of the cost comes from 10% of the people. Most everybody else, they go get their checkup every year. And, they're otherwise healthy. But it's really just controlling the cost of those few large claimants. And, then you can pretty much give the rest of the benefits away for free if you do that. And so, these TPAs have gotten really good at that. And then so now all of a sudden the reinsurance or the stop loss risk on a health plan becomes very, very profitable because you're not having those super catastrophic claims.
Unless you have a pandemic, then everything is going to shit and it's a catastrophe within the health insurance. But that's a different topic. And you basically, your solution, the captive solution, kicks in because the TPA can use that to optimize the cost for the end user.
Correct. Yeah. Instead of just buying their own, instead of just buying reinsurance, at some low level and paying a bunch of premium, they still buy reinsurance or stop loss, but they're taking on a portion of the risk in their own insurance company because it makes sense to do so.
Tell us a success story about one of your customers, how you made them better.
Well, so we just reviewed this the other day. So we had a client come to us in 2007. We set up a captive for them, and they were doing it for their workers' comp. I think they were taking the first $250,000 on their workers' comp, and wanted to put that deductible inside their own insurance company. 2 years later, we took over their health plan, to come back to the health, and we put that into their captive. And they adopted this model that we were just talking about, where you look at the data, having control of your own data is really key. And then, they steer their employees to the right facilities. So they don't go to the highest charging facilities. They go to the ones that, again, they can get a fair price at. And we looked back over what would be 12 to 13 years now. They pay less today than they did back in 2009 for their health insurance. And if you look at the inflation trends on health insurance, I think it goes up and up and up every year, way outpacing inflation, except for maybe this most recent year. But every other year, it's 4 to 5 points above the normal inflation rate. So the trend line is going like this, and their trend line is going like that. They're actually paying less, and they can offer better, and they're offering better benefits. So that's the longest track run, one we have like that. But then we've got a handful of other clients, that started later, but they're having similar results. So again, it's having access to the data, and then actually taking action to do something with it to control that cost.
I wonder if we should have started with, a big disclaimer. Anything that we're going to talk about is not an investment advisory or anything like that, or trying to convince you to buy anything. But having said that, I think, are you Series 7 because you started at some sort of a financial advisor?
Yeah, we actually gave up our investment licenses. So when we started forming the captive insurance companies, at the time, I think it's less prickly now, but at the time, that raised a lot of questions with the regulators who had this, managing the Series 7, the Series 6, all of that. We said, you know what, we'll just let those go. So we're not investment advisors. We're not money managers. We actually, we get a lot of our clients from other investment advisors who have, they'll have the one or two clients in their book of business where they say, oh, I think a captive might make sense, for this particular client. They'll bring us in to discuss it, set it up, and then they do the money management.
Cool. So while we are talking about inflation is going up and captive can actually, inflation is going up and the value of the money going down, the value of the captive is going up even faster. And again, not financial advice or anything like that. basically, in a nutshell, it sounds like insurance now is a better investment or a better way to keep the value of your money.
I think so, because I mean, not only is inflation going up just in products, generally, but we're seeing it in the insurance marketplace. So
Mm-hmm.
property insurance, auto, you know, D&O. I mean, cyber liability, right? We talk about, all of these carriers, they haven't collected enough premium over the years to compensate for the judgments and the losses that they're paying out. So they're making up for lost time, and they're increasing people's premiums aggressively. So
Yes,
now
they do.
our clients that have had captives for 10 plus years, they're able to weather that storm a lot better because they can just take the risk on themselves, or they have access to the reinsurance market to go find some additional carriers to provide them coverage. Those that haven't, now they're kind of wish they had, but they're scrambling to put a solution together now.
So let's talk a second about, well, I want to touch about cyber insurance and about the reinsurance. Do you do anything in the cyberspace?
We have a lot of our clients put the cyber risk in their captive, and one of two ways. Some, they'll just do the entire policy. So you know what, I'm gonna self-insure this risk, and rather than paying the carrier, I'm gonna do cyber inside my captive. That's one path. The other path is we have clients, they buy cyber from their brokers, but the coverage terms are constantly changing. And then there's interpretation issues around, okay, you had a loss. Is it a covered loss? And there's a lot of exclusions. So a lot of our clients will set up a supplemental or a gap policy just to respond in case something crazy happens that isn't covered by their traditional cyber. Because what happened under cyber was it came out, they had traditional underwriters underwriting risk, cyber risk, that they didn't know anything about, didn't understand. So it didn't cover anything. So stuff was always excluded. Coverage was always mismatched. So then the carriers went and hired a bunch of tech people to be underwriters. And then, so they got, all the stuff covered, but then they weren't charging enough. So then they've eaten all these losses because they wrote these broad policies to cover all the risk. But then, with the frequency of the way people are getting, scammed now, with phishing attacks and ransom attacks and things like that, you had all these policies responding to this multitude of losses, and then now they're coming back and trying to figure out, trying to right size the coverage. What do we want to cover, and how much do we want to charge for it? And it makes it very difficult to be a cyber buyer right now.
Yeah, I find the cyber insurance space very, very interesting. On one side, being an Israeli, although I've been in the US for 13 years, have good access to the brains and the innovation that we see coming out from Israel, especially in the cyber insurance, cyber security. And I get all these alerts from the different channels. And with the things that changed recently, especially under the leadership of Lloyd's, that, let's say in August, there was a memorandum by the director of underwriting for the cyberspace. And basically they said, listen, if there is a hack by a state or a state-backed organization, it's not covered. So make sure that you tell everyone that it's not covered. And I think that the trigger or the effective date for that will be somewhere in March 2023. And it's such a big thing because nowadays we see more and more targeted to the private, to the SMBs, to the corporate. And then you have something which is sort of a catastrophe because most of the attacks that are coming from, Russia, Iran, if you look at the most wanted on the FBI, there are Iranians and I think North Korean. The Russians disappeared recently from that
Oh,
list
really?
because most likely it's some sort of a negotiation thing that they do with the Ukraine. I don't know. I just speculate. But it's the small details that we need to connect. But at the end of the day, it's impact everything. Now, if you have an attack, if God forbids they're attacking an infrastructure, because we've seen all kinds of ransomware on hospitals in the UK and other locations. Now, if there is an attack on an infrastructure, let's assume they managed to take down the Texas power grid because it's isolated by itself, right? That's a catastrophe. That has
Absolutely.
an impact of billions of dollars of lost GDP for the state of Texas, and of course for the US part of that. So it's very interesting to see how we're starting to prepare for that, and with captive and the risk and everything, everything is starting to be set down, because at the end of the day, it has a financial, it has quality of life. There are so many derivatives that coming out of that. The ripple effect is big. Now,
Yeah, it's an interesting observation, right? I mean, people think catastrophe, they think hurricanes, earthquakes, but to your point, if you had a truly catastrophic cyber attack, you almost can't put a dollar figure on, what something like that could be.
use this catastrophe to talk about the reinsurers. So,
No, but but you think about those latent risks. I mean, you mentioned the pandemic earlier,
mhm.
right? And so there's the quantifiable, they got the PPP loans out, help businesses stay afloat. Um, that was fantastic. That was fine. But then you think about, like, from an education standpoint, we're talking, it'll be 10 years before, we see the educational shakeout, or the results of, students just basically, missing a year, some of the, kids getting on the Zoom setups, and, you hear horror stories about, just the kid would be on for 5 minutes and he just walks away and just doesn't attend class that day because his parents are at work. And, but it's going to take a long time, for all of that to shake out. And then, how does that affect, productivity in the labor market, and, employability, and all of these things. So secondary and tertiary effects. I mean, it's complicated stuff.
Going back to insurance, captive, active, access to the reinsurance. Let's talk about how does it helpful and how do they actually utilize it?
Yeah, well, the main reason it's helpful is, in so many traditional insurance spaces, you only have a few carriers that are actually operating in that space. So having reinsurance options gets you access to additional markets, just quotes, capacity, et cetera. I think about it, on the health insurance side here in California, you have like 5 main carriers you can go to. That's it.
That's it.
But for stop loss,
Because
yeah, pretty much. I mean,
when I read the last report from the NIS, NICS, NIAC, there are about almost 7,000 different domicile and non-domicile insurance companies, and part of them, of course, are only regional. So,
yep.
it's amazing that at the end of the day you have less than 10 that can actually be relevant for a specific business.
Yeah, I mean, it's very difficult, right? You have Anthem, Blue Cross, Blue Shield, Aetna, Cigna, United, and then
You're talking health again. Sorry.
This is health. Sorry. Yeah.
Let's do a quick raise a hand. We are talking health.
But, for stop loss carriers and reinsurers, there's 25 that we can go to on any given day. So you get extra capacity. But the same thing holds in the property and casualty side of the equation too. Now, for standard everyday risks, you got a dozen carriers at any given time. But for the more challenging, difficult stuff, either industry or risk, there's only certain carriers that have the appetites. And so, having a captive with access to reinsurance can, help with some additional capacity. And then, it's not quite as pronounced as people think, but, there is a sort of a wholesale element as opposed to, retail. So some of the margin, there's some, there's a few points there in terms of just, rate savings, that you can get by, utilizing the reinsurance marketplace.
Mm-hmm.
And then, and then partnering with carriers that, understand captives and confront and reinsure around them, it just helps people, build a better captive structure.
So a small company or a university, you mentioned, I think UCI, they want to have a captive, they reach out to you, you build a captive for them. Are you connecting them to the reinsurance? Who are the different people that you bring in to make this picture and efficiency?
Yep. So yeah, we get introduced to the prospective captive owner, have an introductory call. We do some education, talk through some of the concepts we've been, batting back and forth here, and then, get an idea of what they would like to accomplish. And if it seems, if there's interest on their part and it seems like there's traction on our part, we'll collect some basic information, copies of insurance policies, underwriting information, and we'll do what we call a preliminary feasibility study. And it's a document we come back with and say, hey, here's 2 or 3 different ways you could structure a captive program, have a more in-depth discussion around that, what everything would mean. And then, after that, maybe, you update it or make some adjustments, but they've got an actionable, framework to say, yes, I want to do that. And then if they decide they want to, then they would engage us to set it up for them. And then we would, manage it going forward.
And if they need to do the reinsurance, is it through you as well, or do they use Aon or Marsh or the reinsurance brokers?
Yeah, that can depend. I mean, sometimes we'll, help put it together. Other times we're, the opportunity is coming in through their broker.
Mm-hmm.
And then so their broker can, go out and have those discussions and access those resources. Or, yeah, we might have to, if it's something esoteric or we haven't done before, then we might have to, phone a friend, be it a reinsurance broker or some form of intermediary to go access those contacts. So
Okay.
we tend to stay nimble in that regard because, just you never know what the deal is going to look like.
Okay, Jared, I can't believe but we already passed the 30 minutes mark a few minutes ago. So
just like that.
I know. It's when you pull out the cigars and whiskey and talk about poker. And
next time.
Yeah, most definitely. And we can do it in person. We are just an hour drive away, right? In Southern California. So let me ask you the last question that I'm asking everyone, and that will be a great opportunity to talk about golf. Can you give us a tip? It can be a life hack, a movie, a place to travel, or golf.
I'm not sure I'm the one to give out any tips on golf. Similar to backgammon, I'm in the phase of just trying to get functional at the game. I would say one book or concept that I've been revisiting. There's a book called Factfulness by Hans Rosling. I think he's passed away now, but it's Factfulness, and it's 10 reasons we're wrong about the world and why things are better than you think.
Ooh,
and it
love it already.
It was published not too long ago, but I found it important because you go to the media, be it CNN, Fox, whatever, everything's bad. Everything's bad. It's, they're trying to trigger the fear response, right? But if you actually look at the data and you look at our lifestyles, actually things have really never been better. And, just for my own, sanity, that felt important to me to engage with those type of concepts. And I was, and so Paul Johnson is another guy. He used to be the mayor of Phoenix. Now he runs a business out in Scottsdale, but he gives a great talk about why, for, all the, negative discourse, America is still a great country. And when you look at the data, things are actually much better than we think they are. So, so my big life hack has been, digging beneath the surface level media that you hear and really looking at, the true state of affairs. And, of course, there's always going to be issues to work out. Politics is always going to be messy. That's where we go to sort these things out. In some ways it shouldn't be clean. But at the end of the day, society as a whole in progress is, I think we're better off. So,
well, my not counter, but a similar recommendation on a book will be Americana, which covers 400 years of American capitalism. And I need to Google quickly here the name of the author. So that's Bo Srinivasan. Of course, I mispronounced the name. And I love that because it talks about all different things and the concept that we know, but we never really understand what happened in that history. We don't talk about the financial history. We just talk about, oh, there was the revolution, but okay, the Tea Party, what actually caused it? What was the financial incentive behind it? How did it start? How did that impact the capitalism that we enjoy today, right? And all the from going through J.P. Morgan, Carnegie, all those people, that there was some sort of incentive. We know the name. We think about today Carnegie as a big donor and a philanthropy, the name and the family, but he wasn't the nicest person at the beginning, not even at the middle, maybe a little bit at the end. There was a lot of fights and many things, but that's my humble recommendation. Okay.
I'm going to have to check that out. I've got it. I've got that down here. Thank you.
Jarid, thank you very much for joining me today. It was a pleasure interviewing you and having this conversation.
Likewise, I've enjoyed it, and I look forward to cigars and whiskey and poker.
Well, I have a case, but I haven't played poker for many years. Okay.
Just the cigars then.
Okay.